Savita Subramanian, doing mathematics at Berkeley, is very aware of the x-axis, and brilliantly, in her cautious report for Bank of America, she looks at the sequence from taper to tighten to Tina. What happens to Tina if there's no alternative, if we get the first two?
Yeah, I think that Tina is in peril, and she needs to be careful, because here we are in an environment where the dividend yield on the S&P 500 is below where cash yields are likely to be in a year or two. So, you know, all of a sudden, cash looks really attractive in an environment where our economists are forecasting, 8 hikes over the next couple of years. I think that's an environment where you want to own free cash flow, but you don't necessarily want to own the entire S&P 500. So I think we're in an environment where it gets tricky. You're seeing volatility. I think this negative real rates environment is really interesting, because we're now just accepting this as normal. And this reminds me of 2000, when we all accepted a negative equity risk premium as normal. This is not normal. Negative real rates are abnormal, and I think that they're telling us that something is essentially wrong, and we need to see some sort of correction in, at the very least, bonds to get us back to a more normal setting. So I don't know. I look at a lot of the statistics right now, and it looks very similar to 2000 from a valuation, expectation, euphoria perspective. And then it also looks pretty similar to the late 70s, where, or I guess the mid 70s, where folks are really not prepared for the types of inflationary shocks that, or the sustained inflation cycle that we're likely to see.
Savita, those comparisons make things sound really scary, but a lot of people would point out the big heavyweights on the S&P 500 are minting money, delivering massive growth. What would you say back to the people that bring that up?
Sure. So here's what I would say. I agree, and I think the bubble right now is not in stocks, it's in bonds. And that's what we have to do from a stock perspective, is figure out which stocks are going to be hurt by rising interest rates, by rising equity risk premia. I mean, you're seeing really funky stuff happen in the markets right now, and I use that as a technical term. But if you look at, for example, the Treasury market, one of the biggest markets in the world, is starting to show signs of liquidity risk. We're seeing, China real estate, which is literally the largest asset class in the world, starting to fray. So I think these are the areas where we're more likely to see the pain. I mean, from a U.S. equity perspective, you're right. Mega cap tech still looks pretty good, but the problem is everybody owns it. And if we're in an environment where volatility starts to creep up and we have to rebalance, I think that the S&P is going to be one of the risk asset classes that sees the most selling. Savita, and that's, again, where I worry about downside.
What's going to pop the bubble that you see in bonds if even the prospect of faster rate hikes from the Federal Reserve has not done it?
Well, here's where I think it gets interesting, because if you look at what popped the bubble in stocks in prior cycles, it was a very similar landscape to what we're setting up for now. We had a Fed starting to tighten into a statistically overvalued market. I mean, that's what we saw in 2000. That's what we saw in a couple of prior market peaks. We had inflation expectations lower than where I actually think inflation is going to be over the next couple of years. And we had an environment where I think, asset allocators were very bullish on stocks. So, I mean, one of the area similarities between today and the prior 3 market peaks is that we saw asset allocators, like the Wall Street sell-side strategists, increase their allocations to stocks by about, 7 percentage points heading into that market peak. That's exactly where we are now. So, as Tom said, I like to look at the numbers, and a lot of numbers are rhyming with market peaks in prior cycles.
They might be
a story for negative real rates. Sorry, go ahead.
No, but they're rhyming, and this gets to the negative real rate discussion. They're rhyming, but it's a different circumstance with a Federal Reserve that has shown a greater willingness to step in if there is market turmoil. A lot of people are saying, don't fight the Fed, don't fight the Fed's put. Do you think that that's overplayed, that they're not going to come in the face of turmoil?
Well, look, I think that, they're going to try to fix everything, but the Fed has tried to create an inflation cycle for 10 years. Who's to say they're going to be able to keep it under control? I think that the Fed is certainly not in a position where they want to roil markets and scare investors. But I just wonder, do they have the tools to essentially accommodate an environment where inflation is starting to rise, economic activity is building, and that's positive for the economy. But, we're starting to see labor inflation really creep into margins. I mean, this is an environment where I don't know if the Fed's going to be able to quell market volatility. I mean, the other thing that I think is interesting is that right now we're in an environment where our rate strategists are forecasting a pretty big pickup in rates volatility. So we're more likely to see rates volatility. We're more likely to see equity market volatility. This is a different environment than what we've enjoyed over the last couple of years or even the last decade. And in that environment, the number one factor that we need to care about is the cost of equity capital. If volatility rises, the equity risk premium increases, and that's basically game over for a lot of these longer duration stocks and companies that have thrived on a falling cost of capital. So, I don't want to sound too alarmist, and I think, we're not looking for massive downside, big bear market, but I do think the probability of a 10% correction in the near term or, over the next 12 months is elevated. And our market forecast is flat. We're not looking for down market returns, but over the next 12 months, I think it's going to be a tough grind.
Savita, before we let you go, I've got to get this question in. My approach to this job, as you know, has always been to respect a forecast, because a forecast by definition can not be wrong. It's a forecast. But when you look back at this year, your forecast ultimately fell short of where this market was. And Savita, I just wonder, the lesson of this year, what has it been for you and the team as we look back at this year and look ahead to 22?
Yeah, so I think the lesson this year for me was don't underestimate corporate America. This is why, I think if I'm wrong next year, it'll be because corporates managed to keep margins intact. I think the lesson for me is that in a long duration market environment, if interest rates and the cost of capital falls, that's super bullish for stocks, and that's not something that we were penciling in at the beginning of the year, was a falling equity risk premium. So it's pretty shocking, a lot of the trends that we saw this year. And then I think negative real rates, like the fact that we're now forecasting negative real rates, that's not something that I thought was going to be in the, in the landscape of realistic assumptions.